Have you ever wondered why some people buy a stock at exactly the right time while others buy the same stock and incur losses? Is there a way to find out or to identify whether a stock price is likely to move up or down? Can we make better investment decisions by simply studying stock price movements? The answer is yes. That is exactly what technical analysis helps us to understand. Welcome to Finance and Accounting Academy. I am Dr. Bharathi Sunil. In today's video, we will learn technical analysis from the basics in a very simple and practical manner. Before we begin, let us see what we are going to learn today. We will understand the meaning of technical analysis, why it is important, the assumptions behind it, market trends, different types of charts, candlesticks, support and resistance, moving averages, indicators, advantages, limitations, and finally we will summarize everything with the key takeaways. Now, meaning of technical analysis. Suppose if I asked you whether tomorrow Hyderabad will receive rain, we generally look at the weather forecast based on past weather data. Similarly, in the stock market, technical analysis studies past price movements, means how the price was there in the past period, and trading volume means how much of trading got happened in the market to estimate the possible future direction of prices. Means here we are taking into consideration two things. What's the first one? We take past price movements, means historical price movements, and also we'll see trading volume. These two will help us to predict our future stock prices. You can see here past price plus trading volume is equal to what? Future trend. Next, why technical analysis is important. You want to know the importance of technical analysis in investment management. Here I would like to tell you a story. Imagine you want to buy shares of some well-established company. The company is fundamentally very strong. But should you buy today, tomorrow, next month? How you will decide? Here, technical analysis helps us to decide the right timing, because here you know what is a good company, but whether to buy today or tomorrow or take some time to buy, that you will come to know only when you understand technical analysis. So here, first you will see market trends. So technical analysis helps us to identify market trends. Here we can understand whether the market is having uptrend or whether it is going downtrend or it is going sideways. This I will explain in the next slide. And technical analysis helps us to find the right entry and exit points. Means when we have to buy and when we have to sell, that time we can improve. That time you can know only through technical analysis. We should know this timing to improve our returns. Next, technical analysis supports risk management, because traders here they use support, resistance and stop loss levels to limit their future losses. Means what? To limit their potential losses. Means if they are understanding what is the support and what is the resistance and stop levels of their stocks, then they can reduce their future losses. Next, it measures the market sentiment. Means how the buyers and sellers are reacting, means what is the psychology. This will help us to know whether the investor is having fear or is he greedy. This will be known through technical analysis. Next, this is useful for short-term and medium-term investing. And finally, we can say that it complements fundamental analysis, because fundamental analysis will help us to identify which stock to buy, but technical analysis helps us determine when to buy or when to sell. Now we will discuss what are the assumptions of uh, technical analysis. See here, you see the first one, market discounts everything. Means what? Imagine a company announced excellent quarterly profits, and thousands of investors immediately react when the company announced its profits. Because of that reaction, the stock price changes quickly. Therefore, technical analysis believe that prices already reflect all publicly available information. Here you can understand that all available information, that means the company news, profits, government policies, and investors' expectations is already reflected in the stock prices. So therefore, we can say that market discounts everything. Now coming to the second assumption, prices move in trends. You know, prices don't move randomly every day. Here you can see prices are moving uptrend and the prices are moving sideways, right? And prices are also moving downtrend. So when the prices are increasing, it is called what? Uptrend. When the prices are just moving, like for example, if the stock price is 100 rupees, it is moving around 101, 102 or 99, 98. It is called what? Sideways trend. Right? And the same way, what is downtrend? When the prices are decreasing, say for example 100, 90, 80, like that. If the prices are decreasing, it is called what? Downtrend. So what you have understood here, stock prices usually move in an upward trend, downward trend or sideways trend rather than randomly. Now coming to the third one, history repeats itself. Here you should understand that human emotions like fear and greed don't change. So similar price patterns appear repeatedly in the market. This I will explain it clearly now. Human emotions never change, right? Fear today is the same as fear 20 years ago. Greed today is the same as greed 20 years ago, because people behave similarly. Similar chart patterns appear again and again. Because if the prices are increasing, what is the greed that we have? We'll wait for some more time so that our prices will increase and we can sell at a higher price, right? At the same time, if the prices are falling, then again, then we may not get the same price what is there today in future, right? So what you will do? Immediately we will sell that, right? So like this, we'll have fear and greed. So this is called what? Trading psychology. So in this way, our emotions will affect stock market decisions. Now we'll see trends. What are those trends? Uptrend, downtrend and sideways. So first I will explain you uptrend. Uptrend means here how the prices are increasing. It's like a staircase. If a stock market has been rising steadily for several weeks, here you can find higher highs and higher lows, right? So say for example, here the price is 100, 110, 120, 135, 150. Then it is called what? It is called uptrend. And now we'll see what is downtrend. Downtrend means here how the prices will be there in the market, like 150, 140, 125, 110, 95. Like this, if the prices are there, then it is called what? Downtrend. Means lower high, lower low also you can see here. Now coming to the third one. What is this? Is called? Is called sideways. Sideways means Here you can see the prices are increasing and decreasing. It is having change, but very little change you can see. When sideways market occurs, when prices move within a defined range for a long period of time. Say for example, if the prices are 100, 102, 101, 99, 100, means there is no clear direction. Then it is called what? It is called what? Sideways. Means when the prices are moving without any clear direction, it is called what? Sideways. And here you can see charts. What are the charts? Line chart, bar chart, and candlestick chart. What is line chart? This blue one is called what? Line chart, right? So here it is very simple to understand because we can find only closing price. It is just for beginners to understand, right? Next, bar charts. What are bar charts? These are called what? Bar charts. Here you can find what is the open price, what is the high price, and what is the low price, and what is the closing price. Means in a day we can, when the day starts, we will find what? Open price, and when the day ends, what price you will find? We will find closing price. In between, if the prices are falling, it is called what? Low. If the prices are increasing, it is called what? High. So like this you can understand bar charts. And coming to the third one, candlestick chart. So in this, what I want to say, different people like different ways of viewing information, right? So some prefer simple charts and others may want more detailed information. Therefore, we are having these three types of charts. What are those? Line chart, bar chart, and candlestick chart. Now, I want to explain candle chart in detail. So you can see here candle charts. I told you O means opening, H means high, L means low, C means closing. So that's called what? OHLC, right? So in candlesticks, we can find open, high, low, close means OHLC. Then we'll find what? Bullish candle and bearish candle. So this bullish candle, so you can see what is the open price, what is the close price, you can see here, and this is the high and this is the low. When the prices are increasing, it is called what? Bullish candle, right? And here means here the open price, say for example, if the open price is 500 and the closing price is 550, it's called what? Bullish candle. And if you see bearish candle, in bearish candle the open price is around 600 but the closing price is around 525. Means here the price got decreased in a day. So it's called what? Bearish candle. I want to explain more. If a candle opens at 100 and closes at 110, means here the open price is only 100 but the closing price is what? 110. Then it is called what? Bullish candle, right? Say if the open price is 100, right, and the closing price is 90. Say if the open price is 100 and the closing price is 90, that means it is called bearish candle. To understand very easily, please remember that bullish candle means upward price move. Usually it's shown in green or white, right? Bearish candle means what? It is downward price move. Means usually it's shown in red or black. So the candle body shows the difference between open and close. Bigger bodies usually show stronger buying or selling pressure. If you see this, you can understand in bullish, if the closing price is more than the opening price, then it is called what? Bullish. If the closing price, in case of bearish, if the closing price is less than the opening price, it is called what? Bearish. Hope you have understood what is bullish candle and bearish candle. Now we'll see price volume analysis. What is price volume analysis? Here you know very clearly that in technical analysis we will see what is the price and what is the volume, right? So why volume matters? Because if the prices are increasing and volume is also increasing, then it is what type of signal? It's a strong bullish signal. Means when the prices are increasing, volume is also increasing, it is a good sign to us, right? Next, when prices are increasing but the volume is decreasing, then it is called what? Weak rally, right? Next, coming to the third one, when the prices are decreasing but volume is increasing, it's called what? Strong selling. Now coming to the fourth one, what is that? If the prices are decreasing and volume is also decreasing, it's called weak downtrend. Understand how the market affects with price and volume. Now let's understand one of the most important concepts in technical analysis is what? Support and resistance. Whenever a price means what price a stock price moves, it does not move continuously in one direction, right? So it often stops, reverses or struggles at certain price levels, like just like ECG, right? It won't be moving continuously in one direction, right? So what you can understand, whenever a stock price is moving, it does not move continuously, right, in one direction. It often stops, means sometime it will be stopped and again it will come back, right? And next again it will struggle to go forward. Like this, our price levels will be varying in the market. So these important price levels are called what? Support and resistance. So first I will explain what is support. Support is the price level where a falling stock tends to stop falling because buyers become active. Means when at this level, when the prices are falling, what will happen? Demand will increase and the buyers feel that the stock is available at an attractive price. So as more people start buying, then what will happen? The stock price often moves upward. When there is a lot of demand for a particular stock, then automatically the price of that particular stock will increase. So what is support? Support is the floor of the market. See here, this is called what? Support. So think of the floor in a room. Suppose if you are sitting in a room, just see the floor. It is called what? Support. If you drop a ball, it falls until it touches the floor, right? Say if you are sitting in a room and you are dropping a ball, then what will happen? That ball fall until it touches the floor. Then it bounces upward. Similarly, when a stock price falls, it may bounce upward from the support level. It won't be at the support level all the time, right? It will again bounce back. Here I would like to explain you with example. If you take the share of some XYZ company, today the share price is 1700, right? Later it got decreased to 1650. Next to 1600. Next to 1550. So how the price is decreasing? First it was 1700, later it decreased to 1650, next to 1600. Next now it is how much? 1550. Means every time the price reaches around 1550, many investors buy that particular stock, right? As a result, the price rise again. Means whenever the XYZ company's share price comes to 1550, many people will purchase. When many people come to purchase that particular stock, automatically what will happen? The stock price will increase. So here what is the support level price? 1550 rupees. Okay, last one question. Why do you think people buy at 1550? Because they believe that the stock is available at a good price. Now we'll see resistance. What is resistance? Resistance is exactly the opposite of support. Resistance is the price level where a rising price faces the selling pressure. Many investors think I have earned enough profit, so they sell their shares. Because of increased selling, the stock price struggles to move higher. So this is called what? Resistance level. Resistance means what? It is the ceiling of the market. Means it is the ceiling of your room, right? So imagine if you are throwing a ball towards the ceiling, the ceiling stops the ball. Similarly, resistance stops the price from rising further. Means the prices can be the prices can be raised up to this level. Later it can't be, right? So this is called what? Resistance. So resistance stop the prices from rising further. We'll give an example. In classroom, if the doors are closed, no student can cross the door, right? Suddenly when the door opens, everyone moves forward. Similarly, when resistance breaks, the stock price often moves quickly upward. So then what is this break called? Sometimes a stock breaks above its resistance. This is called what? Breakout. The means this breakout indicates that the buyers are stronger than sellers. So it often signals the beginning of a new trend, new uptrend. In a normal course, only you can find support and resistance, but only when buyers are stronger than sellers, a breakout occurs. So breakout often signals the beginning of a new uptrend. Like how when the classroom door is opened, every student will come out immediately. Similarly, when resistance breaks, the stock price often moves quickly upward. So here you can see support means what? Buying zone. Means it is floor of the market and price repeatedly bounces upward. And resistance. What is resistance? Selling zone, selling zone. And it is like ceiling of the room and the price struggles to cross. So after support and resistance, now we know that where prices may stop or reverse. Let's see how we can identify the overall market trend using moving averages. Now let's learn another important technical analysis tool called what? Moving averages. Why do we need moving averages? Suppose if I ask you, what was the average temperature in Hyderabad this week? See, remember I have asked about average temperature. Then will you look at only today's temperature? No. You calculate the average of several days, right? Similarly, instead of looking at daily price fluctuations, technical analysis, what they do, they calculate the average price over several days, right? So this average is called what? Moving average. So you can see the definition here. What is the definition? A moving average smooths daily price fluctuations and helps to identify the overall trend. Means sometimes the temperature may be 32 degrees, sometimes it's 35 degrees, sometimes it is 38 degrees. Like that, if you take some days of temperature, we can know the average temperature. In the same way, if you take moving average of stock market prices, if you take closing prices of 5 days, okay, one day it was 100, second day 102, third day 104, fourth day 106, and fifth day it is 108. So if you add all the 5, then you will come to a price around 104. It's called what? Moving average price. So like this, we are having 20-day moving average, 50-day moving average, 200-day moving average. Means we can take, if you take 20-day moving average, it's called what? Short-term trend. Means it shows short-term trend. If you take 50-day moving average, then it shows what? Medium-term trend. Next, if you take 200-day moving average, it shows long-term trend. If you take some ABC company's price, share price, it is 1550. And the 20-day moving average is 1500. Means the company share price is 1550, but the 20-day moving average price is 1500. Means the price is above the average. When the price is above moving average, it is called what? Bullish. Clear? In the same way, when the price is below moving average, it is called bearish. Say here, what is the moving average price? 1500, right? But the market price of that particular share is 1450. Means the price of the share is 1450. The moving average is 1500. Means it is below the moving average price. So the stock is trading below the moving average. So this generally indicates what? Weakness. So it's called what? Bearish. Now coming to the golden cross. This is one of the most famous signals. When 50-day moving average crosses above 200-day moving average, it's called golden cross. Means our 50-day moving average, whatever the price you get, when that crosses the 200-day moving average, it's called what? Golden cross. So many investors consider this as a strong bullish signal. That's why it is called what? Very bullish. Now coming to the fourth one, death cross. Death cross means what? Bearish. When 50-day moving average moves below 200-day moving average, it's called what? Death cross. This indicates what? It is increasing weakness. I would like to give an example here. Imagine two friends are walking. One walks faster than the other. If the faster friend overtakes, that is similar to a golden cross. That is similar to a golden cross. If he falls behind, that resembles a death cross. Clear? A moving average gives us the trend, but experienced traders often want additional information. That's where technical indicators become useful. So now we'll understand what are technical indicators. Charts alone provide a lot of information. However, traders also use mathematical tools called technical indicators. So these indicators help confirm whether the market is strong or weak. To know whether the market is strong or weak, we use technical indicators. Say for example, you think of visiting a doctor. So the doctor does not check only your face, right? He also checks blood pressure, pulse rate, blood sugar, ECG. When all these tests are conducted, these tests will help the doctor to make a better diagnosis. Similarly, technical indicators help traders to make better investment decisions. So here we'll see RSI. What is the full form of RSI? Relative Strength Index. RSI measures momentum. Means it tells us whether the stock is overbought or oversold. RSI ranges from 0 to 100. Generally above 70 stock may be overbought. Below 30 may be oversold. Right? Say for example, if a particular bank's RSI reaches 80, it means the stock has risen rapidly because it is above 70, right? It means the stock has risen rapidly. So some traders may expect a correction. Now, what you have understood here, RSI measures momentum. Next, MACD. What is the full form of MACD? Moving Average Convergence Divergence. So this MACD will help us to identify trend momentum, right? Means possible buy or sell signals we can see here. When the MACD line crosses above the signal line, it is often considered as bullish signal. When MACD line crosses below the signal line, it may indicate a bearish signal. So To have a bullish market, MACD should cross above the signal line. Now coming to the third one, Bollinger Bands. Means what? It measures the market volatility. When the bands become wider, volatility is high. When the bands become narrow, volatility is low. Right? Many traders watch narrow bands because they often precede a significant price movement. Now coming to fourth one, stochastic oscillator. This indicator, this indicator compares the closing price with the recent trading range. So it helps us to identify overbought and oversold conditions like RSI. Like RSI, it should not be used alone. See, after knowing these four indicators, you have to understand that no indicator is perfect. Professional traders, they do not rely on a single indicator. They combine charts, price action, volume, moving averages and indicators for making a better decision. Next, who uses technical analysis? This technical analysis will be used by intraday traders, swing traders, positional traders, portfolio managers, mutual fund managers, hedge funds, retail investors, and investment analysis. So all those people use technical analysis. Now coming to advantages. What are the advantages of technical analysis? The first advantage is what? Easy to understand. Huh? Because unlike fundamental analysis, where we need to study financial statements, balance sheets, and annual reports, technical analysis mainly focuses on price charts and trade volume. So even a beginner can start learning by understanding the basic charts and trends. Here I would like to give an example. Suppose two people want to invest. One studies company's 200 pages annual report. The other studies the stock chart, trend and volume, right? So the second person can quickly understand what's the market direction using technical analysis, right? So when you compare with fundamental analysis, this is very easy to understand. Now coming to the second one, what identifies trends. So the second advantage is helping us to know what is the market trend in three directions. What's the first trend? Uptrend. Second one, downtrend. Third one, sideways. What I have explained previously in our video. So this technical analysis helps us to recognize these trends early. So knowing the trend helps us to make better investment decisions. I would like to give an example here. If a stock price has been making higher highs and higher lows for several weeks, it indicates what? Higher highs and higher lows means what? It is uptrend, right? So many traders prefer buying during an uptrend because the probability of further price increase is higher. Next, risk management means it supports risk management. No investment is completely risk free, you know that, but technical analysis helps us to reduce risk by identifying stop loss levels and support levels. A stop loss helps to limit losses if the market moves against us, right? For example, suppose you buy a stock at rupees 500. Now you decide that if the price falls below 480, you will sell the stock. Means this 480 has become your stop loss. Even if the market falls sharply, your loss is limited because you have set your stop loss as 480. Right? Next, it helps to decide entry and exits, right? Means is one of the biggest advantage. Buying the right stock is important, but buying it at the right time is even more important, right? So technical analysis helps us to identify suitable entry and exit points, right? Suppose if a company is fundamentally very strong company, if you buy it after a huge price rise, you may face a short-term loss. Instead, if you wait for the stock to reach support level or break a resistance level, your chances of making a better trade improves. So we have to remember here that fundamental analysis tells us what to buy, but technical analysis tells us when to buy and when to sell. Next, what's the last advantage listed here? Useful for traders. Means technical analysis is especially useful for intraday traders, swing traders, positional traders. So these traders mainly depend on what? Price movements rather than company financial statements. Say for example, an intraday trader buying and selling shares within the same day cannot wait for annual reports, right? So instead what they do, they analyze charts, trends, volume and indicators to make quick decisions. So the major advantages of technical analysis are: it is easy to learn, it helps to identify trends, it provides better entry and exit points, it supports risk management, it is useful for traders. Now we'll see limitations. Although there are many advantages and although technical analysis is a powerful tool, still it has certain limitations. So every investor should understand these limitations before using it. It cannot guarantee profits, right? The first limitation is that technical analysis cannot guarantee profits. It improves the probability of making better decisions, but there is no method that can predict the market perfectly. Say for example, even if all indicators suggest the stock price rise, unexpected events sometimes what will make can completely change the market direction, right? Second one is what? Ignore unexpected news. Stock prices are affected not only by charts but also by unexpected events, right? Suppose a company announces fraud, or the government introduces the new policy, or suppose there is a global crisis. Even if the chart looked very bullish yesterday, the stock price may fall sharply today, right? So technical analysis cannot predict unexpected news. Next, cannot predict every price movement. That is also true. The stock market is influenced by many factors. Therefore, no analysis method can accurately predict our price movements. Right? Say for example, sometimes a stock breaks above resistance, giving a buy signal, but instead of rising suddenly, it falls. This is why traders should always use stop loss. So stop loss will at least reduce their loss. Next, give probabilities, not certainty. So this is one of the most important points in technical analysis. It works on probability. So it tells us what is likely to happen, not what will definitely happen. So it only gives us probability, not certainty. For example, suppose a weather forecast says there is an 80% chance of rain. It does not mean it will definitely rain. Similarly, technical analysis gives us the most probable direction based on available information only. Next, unexpected news can change trends. So whatever the news that is unexpected by us, not expected by us, will definitely can change our trends. So we have to be very careful that if, it is showing in technical analysis that we have to purchase or we have to sell. If you take decision along according to technical analysis, but because of some unexpected news, we have to change our decision also. Next, false breakouts may occur. Sometimes a stock price moves above the resistance level and it gives a buy signal, but after a short time it falls below, means it falls back below the resistance. This is called what? False breakout. Say for example, a trader buys immediately after the breakout. The next day the stock falls. So without proper risk management, the trader may incur losses. So you have to you have to be very cautious with the false breakouts. Next requires experience and discipline. So technical analysis is skill that improves with your practice. So learning chart patterns alone is not enough. Successful traders also need what? Patience, discipline, and proper risk management. Say for example, two traders may analyze the same chart, but one follows the trading plan with discipline, the other follows with emotion. So even though both use the same analysis, their results may be completely different, right? So with this discussion, we can conclude that technical analysis offers many advantages. It helps to identify market trends, improves entry exit. So with this, what you can understand, technical analysis is having advantages, but it also have limitations. What are those limitations? It cannot guarantee profits and should never be used in isolation. Right? The best investment decisions are made by combining technical analysis with proper knowledge, discipline, and sound risk management. So technical analysis is like a GPS. While driving, what you do, you use GPS, right? So a GPS guides you toward your destination, but you still need to drive carefully, follow traffic rules, and respond to unexpected road conditions. Similarly, technical analysis also guides investment decisions, but investors must also use discipline, risk management, and sound judgment. Now we have reached the end of today's session. So before we conclude, let us quickly revise the important concepts what we have learned. This summary will definitely help you to remember the key points of technical analysis. So this technical analysis studies price and volume. So first we learned that technical analysis is the study of historical price movements and trading volume. So unlike fundamental analysis, which studies companies' financial performance, technical analysis studies the market behavior. So this is the foundation of technical analysis. Our second takeaway is that prices generally move in trends. The three major trends are uptrend, downtrend, and sideways trend. As investors, our first responsibility is to identify the correct market trend before making any investment decision, right? So say for example, if the market is already in an uptrend, so our buying opportunities are generally more favorable than in a strong downtrend, right? Now coming to the third one, charts help identify opportunities. So we also learned that charts are like maps for investors. So just as a map helps us to reach our destination, stock charts also help us to understand the price movements. So we have understood here different charts like line charts, bar charts, candlestick chart, which are providing us valuable information about market behavior. Now coming to the fourth one, volume confirms price movements. This is a very important concept. Price alone is not enough. Volume tells us how strong a price movement is. Say for example, if a stock price rises along with a high trading volume, the upward movement is generally considered stronger. Therefore, always price and volume go together, not separately. Now, fifth one is what? Moving average helps us to identify trends. So we also discussed moving averages in today's video. A moving average smooths daily price fluctuations and helps us to identify the overall market trend. If the stock price is trading above the moving average, it usually indicates strength. If it is trading below the moving average, it may indicate weakness. Next, indicators provide additional confirmation, right? We briefly discussed about technical indicators such as RSI, MACD, Bollinger Bands, and stochastic oscillator. These indicators should not be used alone. They provide additional confirmation. Means along with others, we have to use this as additional confirmation before making any investment decisions. Next, risk management is essential. This is probably the most important lesson from today's lecture. What is that? Risk management is essential. No matter how good your analysis is, every investment carries risk. Therefore, always use stop loss. Invest wisely. Avoid emotional decisions. Don't go for emotional decisions and protect your capital. So, successful investors focus not only on earning profits but also on limiting losses. So, earning profit is not our focus always. We should always focus on limiting losses. So, with these takeaways, we have completed our introduction to technical analysis. So, let us conclude today's session with one final thought. Technical analysis is not about predicting the future with certainty. It is about making better investment decisions by understanding market behavior and managing risk effectively. So I would like to conclude that technical analysis is like reading the pulse of the stock market. So if you want to know the pulse of the stock market, use trading analysis. And this trading analysis will help us to understand how the market is moving and what is the potential and buying and selling opportunities for investors, and how to manage our risk. And in technical analysis, what you have understood that no method is perfect. So you have to use this technical analysis with discipline, proper risk management, and it is a continuous learning. So technical analysis tells us when to buy, when to sell, and when to wait. So remember these 3 points, what technical analysis says: when to buy, when to sell, and when to wait. So technical analysis is a decision support tool, not a guarantee of profit. Dear students, today we have learned about fundamentals of technical analysis. We understood what technical analysis is, why it is important, what are its assumptions, market trends, different types of charts, candle chart, support and resistance, price and volume analysis, moving averages, technical indicators, advantages and limitations. So from today's session, I would like you to remember one important point. Technical analysis is not about predicting the future with certainty. It is about making better investment decisions based on market behavior. It helps us to answer 3 important questions. When should we buy? When should we sell? When should we wait? However, remember that no analysis method can guarantee profits, right? So successful investing requires what? Knowledge, patience, discipline, proper risk management, and continuous learning. So never make investment decisions based only on tips, rumors, or emotions. Instead, analyze the market carefully and make informed decisions. So I hope this session has made technical analysis simple and easy to understand. If you found my lecture useful, please support my channel by liking this video, sharing your thoughts or questions in the comment section. So sharing this video with your friends and classmates, and subscribe to Finance and Accounting Academy by pressing the notification bell so that you don't miss our upcoming investment management lectures. In my next video, we'll discuss more on investment management. So don't miss it. Thank you very much for your valuable time and continuous support. So this is Dr. Bharathi Sunil from Finance and Accounting Academy. Keep learning, keep growing, and invest wisely. See you in the next video. Thank you.